Hold that thought. Let's go to the breaking news desk now with Simon Hobbs. What are we hearing from the French finance minister on these downgrades?
Well, in a national address, he has confirmed to the French people that indeed S&P has notified France that it will be downgraded by one notch. He says it's not a catastrophe. They would have preferred to keep their AAA rating. Moreover, he says the markets have anticipated that the downgrade would come. Importantly, the French finance minister goes on to say that labour costs are France's weakness and that they must keep reforming the country's economy. This is important because the loss of the AAA rating may be seen as a political failure by Nicolas Sarkozy before the French people, and it may open the way up to the opposition socialists winning power at the French presidential election. They might not be in train with Angela Merkel. They might not be so pro-austerity and reform. And were there to be a break between France and Germany, that would indeed be bad news, guys, for the single currency. Back to you.
Okay, thank you very much for that, Simon Hobbs. Let's get back to Marc Faber. With regards to how an investor should be viewing all of this, what is the investment case or otherwise for Europe right now?
Well, basically, European stock markets last year were down between, say, 15 and 30%, depending on the market. And European stocks grossly underperformed the US. I mean, the whole world grossly underperformed the US, which actually in 2011 performed reasonably well. The US was flat on the year, and the utilities index was up and so forth. But the other markets in the world, emerging markets and European markets, were very weak. Now, I believe that sometimes in 2012, the outperformance of the US vis-a-vis other markets will cease, and that you have to move back into quality companies in Europe and into emerging economies.
Are there any particular European companies that you can name?
Well, I think companies like Novartis, Nestle, Total are reasonably good value. I mean, they're not compelling values, but you understand, with zero interest rates, it's very difficult to value anything. And anything that has a dividend yield of, say, 3% compared to zero interest rates is relatively attractive. And I believe in the world, the central banks will keep interest rates below the rate of inflation. In other words, what you will have is negative real interest rates for essentially as far as the eye can see. And in that environment, you want to be essentially in real estate, and you want to be in equities, and you want to be in precious metals.
And one thing from your latest report, Mark, is that you believe that a high-quality basket of U.S. large caps will return 5 to 7% annually for the next few years. So to our audience out there, largely watching in the United States, is everything that is happening, a potential China slowdown, the Eurozone issues, is that potentially a positive for capital inflows into U.S. equities?
Yes. And look, the worse the global economy looks, the worse the Chinese economy collapses, if it collapses. But anywhere where there will be a significant slowdown, there will be a reaction in terms of money printing. And money printing can lift equities, whereas the real economy continues to decline. It's like in the last 10 years, basically in the U.S., standards of living of the average person has gone down. But people that were involved in assets, in real estate, and in equities did reasonably well.
We've got just 10 seconds. You made the case for gold. Okay, we just have to break in here. Marc Faber, thank you very much for joining us today.
It's my pleasure. Thank